Hello and welcome to the Humans versus Retirement podcast. I'm your host, Dan Haylett. Today, I am delighted to be joined on the show by my great friend and fellow retirement planning renegade, Abraham Okusanya. Abraham, welcome to the Humans versus Retirement podcast.
Hi, Dan. Great to be here. Thank you for having me.
Lovely to have you on the show. We've picked a bad day. I don't know when this is going to be. This episode's going to be aired, but this is budget day. So grateful for your time, and it's not just budget day. It's from what the rumours are. I think it's going to be pretty a pretty spectacular budget. So. Abraham,
Let's hope it's a better one than the last one.
Yeah, I don't want any reactions like what happened last time, right? I mean, that's just, let's hope it's positive. So, Abraham, before we get into the conversation, I just want to touch on why I'm so excited to have you on. And I think why we are really great friends and why we have, I think every time that we talk, we have wonderful, in my mind, mind-blowing conversations. So to the art and science of how retirees spend their money and speaks across the globe around that topic. He's the founder and CEO of Timeline, which is a brilliant technology platform that helps retirees invest and spend with confidence. Helps me communicate that message to retirees, which is wonderful. I use that platform and the people I work with absolutely love what we do and the work that we do through Abraham's vision and the technology that he's built. He's also author of a brilliant book called Beyond the 4% Rule. A link to that book will be in the show notes. I highly recommend purchasing it. And it talks about the science of retirement portfolios. And he's the host of two brilliant podcasts. So he's well versed in this. And links to all of those podcasts will be in the show notes. So, Abraham, I can't wait to dive into your specialist subject, which is how to spend money.
Yes, Dan. Thank you for the kind words. I'm really looking forward to it.
So, I want to touch on a couple of points. Really, I think one thing I come across a lot is that people are far too conservative when it comes to spending money in retirement. I'm a big advocate of what I've coined, I've nicked, I think, kind of the go-go years in retirement. So spending money whilst time and health is on your side. But people get too conservative, don't they?
Absolutely. I mean, I think that the subject of spending money shouldn't be that hard, should it?
No.
Because we spend all our lives or most of our lives saving it. So you would have thought that when it comes to spending it, it would be relatively easy. The issue, though, is that it's not. And when I talk to people about this, what you probably had for breakfast this morning, which is your bacon and egg. And I say that in making this breakfast, the chicken is involved, but the chicken is involved, but the pig is committed. And that's how I think about spending in retirement, because for the most part, stop being a chicken in the sense that it produces the egg and the chicken itself can continue to live and you can eat the egg. Whereas, that's what happens in accumulation phase. Whereas in retirement, your portfolio ultimately becomes the pig in the sense. And ultimately, the challenge is making that portfolio last the rest of your unknown life, so to speak. And that's very challenging. And that results in this problem that we find, that people tend to be overly cautious for not necessarily unduly, because you have unknown lifespan, right? You don't know how long you're going to live for. You don't know what investment returns are going to be in advance. And inflation, the thief that keep stealing, is unknown in advance. So you've got these three big problems that people have to contend with in retirement. Hence, the caution that you find that people end up essentially living too much.
I think it's such an important point. There are so many unknown unknowns that we just don't know about. Does that make sense? I think, and and those three things are really important. I think the reason why we exist in our profession and we do what we do is because people don't know the day they're going to die. They don't know what inflation looks like, and they don't know investment returns. If we knew those three things, I would probably be stacking shelves somewhere or doing something completely different. We just don't. So, and because of those unknowns, we are wired as human beings to be very, very cautious with it. Our brains are still wired where we don't go and look what's rustling in the hedges because we're afraid that we're going to get eaten. That's the reason why we're here. Our brothers and sisters way back when did go and rustle in the hedges and got eaten. So, we're still very cautious, aren't we? We're still very cool because we don't know exactly what's rustling. Must learn from history, surely. So you wrote a wonderful white paper that I'm going to put in the show notes that that talks about a couple of things, and let's touch on that. I think we all believe, I think, that we have to make sure that we believe that spending in retirement goes up every year. But that's simply not true, isn't it?
Yeah, it's not. I mean, the original. I remember essentially throwing my toys out of the pram in the early days when I read all these industry article. They're not research based in any way. That basically talks about the U-shaped spending in retirement. In other words, it says that, think of the first 10 years of your retirement. For instance, they say, well, you spend a lot of money, right? And then it says, well, that your spending gradually declines in the mid phase of retirement. And then it says that it goes back up again later in life. And I was reading this and I'm thinking, no, it doesn't. And you read a lot of research both in the UK and in the US, down under in Australia, that basically looks at expenditure pattern in retirement, and it says that, well, the idea of U-shaped spending in retirement is a mirage, that it doesn't exist, and that what you actually find is more like a grasp as people get older. And we've coined this phrase that people talk about, which is to think about retirement in three stages or three phases. Which is to say, well, there is the go phase, which is when you're active and you can go out there and you can still travel the world and spend a lot of time playing golf. I know you're a big fan.
That's my retirement plan right there, Abraham. That's
right?
it. That's it.
Yeah, and then that you will spend a lot of money in that phase of retirement, and then to think of the the go slow phase, which is when you're probably not as active and your spending would decline a little bit, and then you think of the no go phase, which is essentially when you're not you're largely sedentary is the wrong phrase, but you're not as active, and then spending declines. So ultimately, what you find when you look at the research is, broadly speaking, a slow or gradual decline in spending by about 1% a year. Now, it might change, for every single individual. Broadly speaking, people talk about healthcare needs, rising later in the retirement. What research shows is that, yes, healthcare costs rises in later life, but that's essentially, essentially counteracted by the fact that you're not spending as much, if anything, on leisure later in life, and we'll come up with some sort of permanent, I dare say, solution to how the government bridges social care spending, for people in retirement. But that's what the research says broadly, that spending declines progressively in retirement. One thing I should add, there is a new paper recently published by that looks at this, and they make the case that actually they're using they look at shorter periods for people, and they make the case. So they're looking at 5 to 10 years rather than a 30-year period. But they make the case that the decline is not from age 65. It might be less, but again, I am for now taking that with a little bit of a pinch of salt, because when they do look at cohorts of people, so when they look at people, let's say between the ages of 80 and 87, those people tend to spend less than people within the ages of 70 to 80 and sort of in their 60s. The fundamental thing is that the best data that we have so far tells us that spending isn't stable throughout retirement. It's not U-shaped spending. It's actually a gradual progressive decline in real spending and in retirement.
And I think that's really, really important to understand, isn't it? Because, we all know that inflation is the biggest threat and enemy to someone's retirement, retaining the purchasing power. But we have to frame that, don't we? We have to retain the purchasing power of different sets of expenditure needs, right? We don't have to retain the purchasing power of a £20,000 holiday budget a year. That's where this, where the work that we do is eye-opening for people, because when you take that out and then you look at some other things, and then you take out the gifting, and you take it, and you kind of end up towards later life that you are talking about heating and eating costs. And then you mentioned care, which is really interesting, because then I think your phrase you use in your white paper, which I absolutely love, is kind of the worrying spectre of unmanageable care costs are somewhat of a bogeyman, right? I mean, it's a wonderful phrase. We have this real kind of, I need £300,000 in the bank at age 85 just in case I need to go into care. Well, the research says if you get into that point, you're probably going to be only in care for 8, 9, 12 months anyway, right? Maybe 18 months max. And and actually, because your spending budgets have all kind of gradually gone down. I mean, so it's really interesting when we talk about, and because of that, I think again you've got a wonderful stat in your white paper. I think, isn't it typically 31% of our wealth is drawn down by the ages of 70 to 90. So effectively, we're leaving kind of 70% on the table for a what if.
Yeah, absolutely. I mean, look, this is the thing. I mean, and again, all of this data, one of my great obsession, as you alluded to, is just being as data driven as you can possibly be about these big decisions that you have to make in retirement. And one of it is, considering and thinking about whether you're going to need, residential care. Right. And, what the data tells us is, roughly speaking, about 1 in 4 people or 1 in 5 people do need some sort of residential care. And so, which means that, 3 out of 4 people or 4 out of 5 people aren't going to need, residential care. So if you think about probability, then you think, well, maybe that's not going to be required. But again, prudence is important. We have to plan for it. When we do plan for it, then, as we should, then people overegg their requirements. On average, people who do go in care, who do go into care, on average spend, about a year, maybe 18 months, and something like 75% of them, die 24 months into the journey. And so when you approach this from a data-driven point of view, then you end up thinking, well, actually, the fear of care cost, wiping out your retirement is over-egged. And as you alluded to, again, data by the IFS shows that vast majority of people in retirement, maybe that's a good thing. If you do that, right? We all want to leave something behind for the next generation. And so if you do leave money behind for the next generation after enjoying your own life, then that's great. By the way, maybe if that's the path that you're headed, maybe you should actually give more during your during your lifetime, when you can get the joy of giving and seeing the children and grandchildren thrive. But the point is that a lot of us hold on to this money. A, we don't spend it for our needs for as much as we should, and B, we don't enjoy the joy of giving in our later life, and then we become the richest man in the grave. And I don't. So the idea is to try to be as data driven, as objective as possible when making these decisions.
One of my most favourite phrases I use with people that does seem to resonate, and again, it's not original from me. I think I've modified it slightly, but surely we would love to give our money away with a warm heart rather than a cold hand, right? I think that's kind of, this. If you're obsessed about leaving a legacy, you might end up burning through that legacy. Number one, who knows? You might end up leaving a legacy to your children when they're 60. Depends how long you live, and or you don't necessarily want to leave a massive legacy to grandkids that are 18, 19, and it has to go into all these wonderful, complicated trust things that end up just causing more complex and problems. So I think that's it's a really important conversation we have with people. If that's really important, everybody I work with gets more joy out of seeing their money do something. That's the bottom line.
Absolutely. And this is in part numbers, right? So, a lot of the work that we've done with Timeline and with the software enables you to crunch the numbers in terms of looking at not just longevity, but the uncertainty of investment return and inflation. And you can overlay the individual goals and objectives on top of all of that. But that's 20% of the job. 80% of the job is human and emotions. And that's the value that you as a financial planner can add to that conversation, to help people really decide, work out what's truly important to them, what brings them joy in life, in retirement, or all of that, decision making, with as much objectivity as possible.
And I think that, I'm a big believer that actually, a financial plan is a bit of a useless, rubbish word, right? I mean, a plan is wrong the moment it's created. Planning and guidance is the thing. What we want to spend our money on the moment we leave work is going to be very different to what opportunities kind of come our way throughout the journey of retirement and in 5 years' time. And I think that's where, the numbers help, but the emotions and the behaviors that we exhibit during our retirement is so important to understand along the way. It's not something you can kind of do in one hit and then leave it and then kind of, go on that journey, because that journey's wrong. So I think it's really important that we have those ongoing conversations around how you want to align your money and your time with what's most important going forward. And that changes as we progress through life.
It's incredible. You have, when you think about this, maybe you have 4 P's in this. I know you're a big fan of, these type of things, like you have the people or the person involved, all of their emotions and, baggages and their history. You have their purpose. What is it that they really do want to achieve out of life, out of retirement, the plan or the planning. And then you have the portfolio. The problem we have, you see, 5 P's there. Right? The problem we have is that we kind of put, our industry, wider industry, not just the profession of planning, but the wider industry, and the government to an extent, we put the portfolio first. Most people don't have a plan. There isn't detailed conversation about purpose, and and very, very little attention is paid to the individual or the person's behavior. And so your job, the way I see it, is helping people, put the right things first in these conversations.
Do you think one of the problems with this could be that, and again, this is just thinking out loud here, do you think one of the problems could be that people haven't really defined their purpose and their passion, and therefore they step into a retirement either forced or they feel like they have to, or whatever, they get to a point where they step back, and because they haven't done the soul searching, and it is soul searching because what purpose is, what passion is, what you want to spend your money on. Do you think that's a reason why they don't spend enough, because they just haven't really figured out what to spend it on, and they just carry on doing what they did whilst they were working?
Well, let me flip the question. I'll be the one to answer a question with a question. When was the time at any point in your life that someone actually sat you down and said, what do you want out of life?
Never.
This is the thing. We go through our lives with, frankly, no one asking us that question. It's not asked in school. I'm not sure whether it should be, but it's not asked, in school. It's not asked at work. So you will, I'm sure we've had a lot of conversations about this. You would find a lot of people that you ask questions around purpose and what they want out of life, most of them will tell you you're the first person. They might have even gone out to see other financial advisors and things like that. The method and approach that you're adopting is not adopted by something like 90% of the profession. And so, a lot of people that you will speak to will say to you, nobody's ever asked me that question. And so we carry this through our lives, during the accumulation phase of our lives. And then, it becomes such a big thing, an apparent thing in retirement, because all of a sudden we have this pile of money, hopefully. We have huge amounts of time. And so, retirement is a great time to revisit that. And I think ultimately, the entire reason we're doing this is to help people. And yes, I absolutely agree with you that once you've had that conversation with people about purpose, then other things kind of fall in line, in terms of making the most of the money. And, I've seen this definition by others, which essentially says, financial planning is an ongoing, never-ending process of aligning your money and your values.
It's fascinating, Abraham, to go through this with people. I mean, I you ask them that question and you can see the cogs whirring, because again, they've never been asked it. They have no idea how to. There's not even a snap answer, right? They can't even think of something quick because no one's really been down that. And on the odd occasion where we do get an answer because someone's thought about it, the husband or the wife sitting next to them turns around and goes, well, you've never told me that before. Why have we? And so they might have had individual thoughts, but there's a huge amounts of research out there that says that a husband and wife, or spouse and spouse, assume that they're on the same page. Like, they never actually have a conversation because they just assume that they're both on the same page. And my feedback to that is that it's simply not true, because I think bar none, every meeting that I've had with couples, and we insist to work, if you're married, we insist to work with both people, otherwise we don't work with you at all, because it has to be a shared vision that they've never ever had before. And they get enlightened by those conversations, and those conversations lead to other conversations, and before we even get onto decimal places and success rates and pounds and investment returns, there's hours spent on this stuff, because it is so important to these people. So important, because they've then had a conversation they've never had. They've now got to rewind and unpack 30 years of marriage to sit there and go, why have we never spoke about this? You're over here, I'm over here. We need to have our own paths, but we need a joined up one. Otherwise, this retirement thing is just not going to work for us.
This is why I believe that computer, AI, I am huge on those things, by the way. I run a technology firm. I know a few things about numbers, and, we now manage, 2 billion of assets on behalf of, financial advisors for their clients. But I don't believe for a second that, computers, technology is going to replace the role of human financial advisors in helping people navigate this stuff. We've done a lot of research. There's tons and tons of research out there on, the 4% rule, how it applies to your retirement. And there's tons and tons of data out there of that is meaningless until people have had that conversation, and facilitated by a financial planner on what's really important to them and what they're trying to get out of life.
And I think that's why I'm on a mission to, alongside you, and there's a handful of other people that don't mind sticking their head out above the crowd, the black sheep. And, I talk a lot that my job is less about numbers than what many people think it is. And it's all about the human being. And I get the feedback, it feels like therapy, or this is marriage counseling, or, it's pastoral care. It's, I've loved having this conversation with you, Dan. We've got so much clarity out of it. I've not even looked at a number, right? I mean, it's kind of, and I think we all have to realize that money is the lightning rod for our emotions. We would be more comfortable at a friend's barbecue talking about our sex life than our bank balance, right? It's you've seen the research. So, I think we have to understand that the money is so emotional, and there's no profession that exists really to unlock that, because people still view IFAs in brackets or financial advisors as someone that's going to manage my money, and it's simply they're simply not true. I think that's the thing that gets commoditized. What doesn't is the thing that you talked about, and that is financial well-being, financial coaching, financial management, life management, financial planning. Those are the things that are really important and does change lives. Absolutely.
Agreed.
So a couple of points I just want to touch on, and then we'll wrap up. One thing that you mentioned in your white paper is that spending too little is as big of a problem as spending too much. I think that's really interesting.
Yes, because if you a lot of the research around retirement spending, at least the mechanics of it, comes from the work by the legendary Bill Bengen. So let me tell you a little bit about Bill Bengen. Bill Bengen was he graduated MIT as an aeronautical engineer, and he was going to join the US space program. So he decided to do the next best thing, which is to become a financial advisor.
We all have that story, don't we? We all have that story.
We do indeed. And in the early 90s, when Bill became a financial advisor, he kept finding out that people would talk about, how they can, the US stock market is returned, 8% a year, net of inflation. And people will suggest that they can draw 8% of their portfolio and never run out of money for the rest of their lives. And being an engineer, that didn't make sense to him, right? And so Bill took something at the time, 80, 90%, 90 years worth of data, and he wanted sustained retirement that you couldn't run out of money. And so basically he ran rolling period, 30-year rolling periods using this data, and basically came up with this figure of 4%. So which basically says 4% is the of your initial portfolio is the amount that you can spend without running out of money over a 30-year period, assuming that you made a lot of assumption, assuming that you have a portfolio that consisted of 50% US equities and 50% US bonds. And he says in the worst case scenario, a withdrawal of 44% of your initial portfolio will last you 30 years. That is where the 4% rule came out of. The thing, Dan, that nobody tells you about the 4% rule, let me tell you, we'll keep it secret, right? It will be just between us. Lean forward, let me tell you. Only 4% of people understand it, right? This thing is so complicated, it's been so taken out of context that you wouldn't recognize it. If you stop even financial advisors, if you stop 10 financial advisors on the road or at a conference and you ask them to explain the 4% rule to you, I guarantee you will get 11 answers. It's completely different.
Yeah.
Now, the thing about that rule that nobody tells you is that it's based on the worst case scenario, worst historical case scenario, which means that even if you follow that rule to the letter, in something like 99% of scenario, you would end up with more money at the end of the year. In something like 50-60% of the scenarios, you would actually end up with more money in real terms than you started with. And I think it's now that's not to say that the framework that Bengen adopted is not useful. It's actually useful. The problem is that we've got the wrong end of the stick. We held on to a number rather than thinking about the method that he was trying to promote. And that's one of the reasons why, we end up with this tragedy where people actually spend too little money in retirement. There are obviously adaptations and improvement on this method that would ensure that you actually spend, more of your money and you don't die with too much. Those are really the improvement that I am keen, for people to understand.
And I think that is your book Beyond the 4% Rule. And actually, let's rewind that. So Bill Bagan's work has been widely quoted and widely misunderstood, as you said. He is kind of the godfather of kind of this rules-based withdrawal strategy. And because of that, I think most listeners that are thinking about their retirement that have done any type of Google, other search engines are available, search, would have come across something that says the 4% rule. So many of the listeners would have maybe looked at that and read something and then probably closed their browser and gone, I have no idea what this means. So, but what's really interesting is your book, Abraham. Actually, Bill was very complimentary about your book and the work that you did. And I know you've had conversations with him, and I think you're friends and you've spoke about this stuff before. So I encourage everybody that's done a Google search, that's looked at the 4% rule and thought, this sounds a bit dull. I have no idea. I don't know if that's enough or whatever. buy Abraham's book, because it explores this in a bit more detail and goes way beyond the 4% rule. So
my book is even, thank you for saying that, Dan, but my book is even duller because it goes into the nitty gritty of these things and all the different improvements on top of it. The point is that a more dynamic approach to spending is probably right for most people. It's probably the better approach for most people. You know, I shy away from essentially throwing out a rule of thumb, but if you must follow a rule, then it should actually probably be something like 5-4-3 spending rule. By that I mean, in the first 10 years of your retirement, spend 5% of the initial portfolio balance. So if you have a portfolio of £1 million, you know, spend £50,000 and adjust in line with inflation in the first 10 years of retirement. In the second 10 years of retirement, spend 4%, 40,000, adjusted for inflation. In the last 10, spend 3%. You know, what we, you know, the traditional pattern of spending retirement, and overlaying that with the reality of the uncertainty of life and of investment return and of inflation. But ultimately, it's going to be different for everyone. The best thing people can do is to work with a financial planner who truly understands this framework. And I hate advisors understand this framework. But you know, the best thing is to find one that does. And barring that, then it's to try and understand this framework as much as you possibly can.
Absolutely. I will add some things to the show notes. I'm a big fan of guardrails. I think guardrails are a really good withdrawal strategy to put a framework. It allows you to probably have something that's north of 5% to withdraw, and allows you to bask in the glory of return. So let's up with inflation, and if a portfolio gets to a certain level, we're going to give you a pay rise and give you more money. And when the markets fall, probably 4, 5, 6 times over a 30-year time horizon, then we can potentially cut some of that spending. And then having a war chest of cash sitting beside that. I'm a big fan of cash in retirement, because what it does, it alleviates a couple of things. One, sequencing risk of return. It's a big, long phrase. I'll put some stuff in the show notes about that. But also, we're actually saying, what we're saying here is that if you need to cut from your investment portfolio the withdrawal rules, it doesn't necessarily mean that you end up cutting your expenditure, because all you go to your cash, right? So if you're spending £60,000 a year and you have to take £10,000 off your investments, then go to cash for a bit and take another 10. So there's some great stuff around guardrails, and you've done a lot of work, and the technology you've built really helps and assists us with that stuff. So I'll put a PDF of a frame. So these are 3 questions, and I want some truthful answers. Number 1, Abraham, what will your retirement look like?
I don't believe that I'll retire like other people, this idea of never working. I would always want to be engaged and add value. I would probably do a lot of speaking, a lot of advising younger entrepreneurs. But again, ask me in 20 years' time, I might have changed my mind.
There's the answer. Exactly. Who knows? So I'm sitting in front of you. I'm 55. I've established I've got enough money for the retirement that I desire. What would be your number 1 tip for a happy, healthy, and wealthy retirement?
Redefine your purpose.
Fantastic. I think we rewind that 30 seconds, everybody, and listen to that a couple of times. Redefine your purpose. So important. And when it comes to this human versus retirement face-off that we do constantly have, because retirement is a man-made thing. We made it up about 100 odd years ago. When it comes to this face-off, is there anything that I've not asked that I should have?
No, I don't think so.
We've covered everything, haven't we? We've covered so much in 40 minutes. It's been amazing. So, Abraham, look, thank you so much for your time and your wisdom and for your continued work in raising the standards of our wonderful profession. I do deeply thank you for that. Links to Abraham's book and other resources will be in the show notes. And thank you all for listening to the Humans versus Retirement podcast. It's been a pleasure to have you with us today. Until next time, take care.